Fabulous. Thank you. Well, hello everyone, and welcome to JFLA's Financial Literacy Series. My name is Linda Feinholz, and I'm a proud past president of the Jewish Free Loan Association and past member of the board of directors. Just some housekeeping and logistics before we get started. Please, in order to have the best experience today, you can deliberately pick the speaker view in the upper right-hand corner of your Zoom window. And also, we're going to keep everybody muted during the first half during the presentation, so we're able to get a clear recording. And then at the end, we're going to take everybody's questions, bring everybody on camera, let you come off of mute and so on and pose your question. What we have found works really well is if you think of a question while the presentation is happening, go ahead and put it in chat now so we don't lose the question. And when we're done with the presentation, I'll be sure to make sure that we come back to that question and our guest can answer it, bring you into the conversation, and so on. So today I'll be starting by introducing David Horvitz, who's here to present Retirement Planning 101. During that presentation, um, chat will be available to you. The slides will be available to you. And then when it's time for Q&A, I will go ahead and call on you to unmute and bring your question up. And I'll probably have some of my own. That often happens. As many of you know, Jewish Free Loan offers zero interest, zero fee loans to anyone facing a financial challenge. We're not a bank, and we work with our clients to make sure their payments are manageable. If you're interested in learning more about loans, whether for student loans, emergencies, small businesses, or another reason, please visit jfla.org to see the full range of loans we offer. All are zero interest with no fees at any time. And for those of you who are here in Los Angeles, watching this live or during the recording, I want to just confirm for you that JFLA has wildfire loans. You can get all the details on the website. Those loans are available for up to $10,000 without a guarantor or $25,000 with one guarantor. So you can find the information at jfla.org/fire relief, all one word, no spaces. And please feel free to pass it along to anyone you know who's been affected by the wildfires here in Los Angeles. So let me see if there's anything else I want to make sure you know about. That's everything that I have in my notes. So today I'm really pleased to welcome David Horvitz, a certified financial planner and a very proud JFLA board member. David's been practicing comprehensive financial planning since 2002. He's skilled in the areas of taxation mitigation, retirement planning, estate planning, insurance, and personal risk management. He holds a BSBA degree in management from Washington University in St. Louis, an MA in education degree from Pepperdine University, an MBA from Cal Lutheran University, and a professional designation in personal financial planning from UCLA Extension, where he also serves on the faculty teaching the Introduction to Personal Money Management course, the Practical Investing course, and the Mutual Funds and ETFs investing course. So I'm so pleased to have him here in order to share the information he has with all of you today. David, the floor is yours.
Thank you, Linda. It's nice to be here. Welcome, everybody. Thank you for making the time. My hope is that the bulk of the presentation will be about addressing your specific questions. Though before we get to them, I do want to make sure to cover some things broadly and then some other things specifically so that we can get to whatever your retirement needs are. So let's do the next slide, please. So my goal is to talk about money basics in as much as what we need to get to in order to get to retirement. All financial planning is based on making sure that one has the cash they need when they need it, so they can be comfortable throughout their retirement years. So the first goal that anybody should have, and let's go to the next slide, please, is to retire all bad debt. Not all debt is bad. Some debt is quite good, actually, if it's debt that will lead to greater income, perhaps a school loan for an advanced degree or even a basic degree that will get you a higher salary, or a home mortgage that would allow you to buy a house and stop paying rent. Um, a loan to make an investment in your own business, for example. Um, a loan from JFLA, particularly for a small business, which is one of the loans that we offer. 0% interest, that's a great loan to take. But a lot of debt is bad. And the worst of all debts outstanding is really credit card debt. It's the most insidious of the debts because it's not the interest on it is not deductible whatsoever, unlike, say, a home mortgage or an investment loan, or in many cases a student loan. Credit card debt, not only is it the interest not deductible, the interest tends to be among the highest of all debt interests, sometimes 20% or more. So before we even think about retirement planning, the first goal should be making sure that we have no credit card debt, no bad debt. So how do we retire our credit card debt? Let's do that. Next slide, please. Um, the way we think about getting rid of credit card debt, I like to liken it to something called the debt elimination avalanche. And this assumes that you have multiple credit cards with varying interest on them. So the way that we'll do that is the first goal would be to transfer all of your credit card debt that has an interest rate on it to a 0% intro rate credit card. If your credit is good, and we can go to the next slide, please. If your credit is good, you might qualify to get one of these intro rate credit cards where they'll offer you a 0% interest on any balance that you transfer over to their credit card, and they'll give it to you for 12 months or 18 months, which is terrific because you now have that period of time to do the best that you can to eliminate your credit card debt. Now, if you have multiple cards and the intro rate card that you've designated maybe doesn't allow you to put all of the cards on it, let's make sure that we're putting the one with the highest credit card interest rate. So let's go to the next card. So what we want to do is we want to list our credit cards by highest interest rate to lowest interest rate, not balances, interest rates. So maybe I have 25, 20, 15, 10, 5, etc. I'm going to rank them like this. And what I'm going to do is I'm going to pay the minimum balance, the minimum amount that I am required to pay on the lowest interest rate debts. Maybe it's $20 a month, maybe it's $50, whatever it is. I'm going to just pay the minimum. So I won't be actually making progress on eliminating that debt, but I'll just simply be servicing the interest on that lowest rate and the second lowest, third, until I get to the one with the highest interest rate. Let's go to the next one. So the one that I have the highest rate on, I'm going to apply as much of my money that doesn't pay for food or rent onto that card. So that assuming, say, it's a minimum payment every month of, call it $150. If I have an additional $200 from paying just the minimum balances on my other cards or having transferred one or more to that 0% interest rate, I'm going to put that $200 towards that highest interest rate credit card. And this way, I'm not just covering the interest on it, I'm actually chopping away at the underlying debt. And month after month, as I'm chopping away at the debt, two things are going to happen. One, the balance on that card is going to get lower, and it's going to get lower faster. And two, the amount of my payment that is going to be going to interest is going to be less and less, and the more and more is going to principal. So let's go to the next slide. So once I've eliminated all of the debt on that highest interest rate, I still am going to continue to pay the minimum amounts on the lowest interest rate cards bit by bit. And now I have the 150 that I was required to pay on that highest interest rate, plus whatever extra money I had, say, let's call it $200. I'm going to apply that to the second highest rate. And this one is going to be eliminated even faster because I have exactly the same amount of money or more to apply to a card that has a lower interest rate. So like an avalanche pouring faster and faster and faster, even with the same amount of money, I'll start to eliminate my debt more quickly. Next card. I'm sorry, slide. So eventually, I'll be able to eliminate the highest one, the second highest, the third, etc., and I'll be debt free, which is great because then you've accomplished job one, which is to get out of bad debt, and we can move on to job two. Next slide. So job two is to establish what we call an emergency reserve fund. This is money that I have in a savings account or hopefully an interest earning money market account or an interest earning savings account that is just going to be in case of emergency. And ideally I will have about 3 months of my expenses in that emergency reserve, just my expenses, rent, clothes, shelter. I can try to get up to 6 months. If I can get anywhere between 3 months and 6 months, I'm in good shape. It says in here no less than 5 months. That's conservative, but it should be really no less than 3 months. So once I've accumulated an emergency reserve of 3, 4, 5, or even 6 months, now I have enough that I can start investing towards retirement. So what does that look like? Next card. As opposed to saving, which is putting cash away for an expected use in the near future and one that's not really earning much interest, investing is putting money towards a long-term goal that has the potential of earning a much higher return on it than I would get just simply on a cash savings account. And then, moreover, from just simply investing, intelligent investing means doing it in a way that is less like gambling and more like buying a share of a business that is going to do well and that I can enjoy some profits from over a long period of time. So let's go to the next slide. There are several kinds of retirement accounts that are available to everyone, but they can really be broken out into what kind of wage earner you are. If you are an employee who gets a W-2, you're kind of limited on your retirement accounts. If you are this kind of employee, at the very least, you can invest in what's called an IRA, an individual retirement arrangement or individual retirement account, or a Roth IRA in some cases, in most cases, or if your company offers it, a 401k. And I'll describe what those are. If you are a business owner and you maybe have employees or you work for yourself, the spectrum of available retirement plans is much wider than if you are a W-2 employee. So let's talk about first the W-2 employee. If you are working for somebody or a company that offers a 401k, this gives you the opportunity to put money away into an account that hopefully the company will match what you put in there up to a certain amount, or it will at least allow you to put a portion of your salary in the account, which is a tax deduction directly. So it's as if you didn't make the money that you're putting in the savings. So let's say that you make $50,000 a year and you put 10,000 into your 401k account, whether your employer matches it or not, that 10,000 is reduced from your salary. And as far as the government is concerned, you didn't make 50,000, you made 40,000. The 10,000 is going into your retirement savings account where it does not get taxed until way later when you take it out. But in the meantime, the government only taxes you on your actual wages, 40,000. So it's a tax savings in two ways. Um, if you qualify, meaning that you make less than a certain amount of money, you can invest in a Roth IRA. So let's go to the next slide. So a Roth IRA is a wonderful type of retirement plan because it allows you to um, put money away. Now, you don't get a tax deduction when you put money into it, but it grows tax free. And then when you take the money out, you don't have to pay tax on it either. So it's a double tax free advantage. There are some limitations to it. So let's go to the next slide. So the first limitation is that you have to earn, if you're a single person not married, you have to earn less than $150,000. If you're married, your combined income has to be less than $236,000 to qualify for the Roth IRA. If you do qualify for the Roth IRA, you can put in as up to $7,000 if you are 49 or younger, and an additional $1,000 if you're 50 or older. So up to 8,000 if you're 50 or older. The money that goes in there, we'll talk about what happens to that money. But once it goes in there, you can invest it into several thousand different types of investments. And if you're investing intelligently, that money will grow such that at the end of a period of time, it compounds and it grows. You'll be able to take the money out in retirement, hopefully, and you won't pay any tax on it. And you can do this 7 or 8,000 every year, provided you make less than that 150,000 or 236,000 limitation, whether you're single or married, respectively. So let's go to the next slide, and I'm going to talk again about 401ks. So as I said before, if you're making $50,000 in your job, many employers will offer a 401k, which allows you to reduce your income, put the money in this special savings account where, again, you can choose among several investments and it will grow without being taxed as it grows. You do have to pay tax when you take the money out, in retirement, but in the meantime, it enjoys tax-free growth. That's also double tax-free in as much as you get the tax deduction when you put it in, and you get the tax-free growth. The Roth, you don't get a tax deduction when you put it in, but it grows tax-free, and when you take the money out, there's no tax. So it also has a double tax-free benefit. One other benefit of a 401k, however, is that many employers will match their employees' contributions to this savings vehicle. And they'll match it as a employee benefit because it incentivizes good employees to stay with the company, which obviously employers want. They want good employees. So employers might say, okay, if you put $5,000 of your salary into the 401k, we'll put $5,000 in. And the employer also gets a tax benefit for doing that too. So everybody wins, and provided you don't have any credit card debt and your emergency reserve has 3, 5, or 6 months worth of expenses in it, this is a great place to start putting your money. Next slide. If you make too much money and you don't qualify for a Roth IRA, or your company doesn't offer a 401k, or you've put in the maximum amount that you're allowed into the 401k, which is $20,500 if you are under 50, or $30,500 if you're over 50, and you still have money left over. Well, now you can put those funds into a taxable account. Now, it's called a taxable account because unlike the IRA or the 401k, you don't get a tax deduction for putting money into it. It doesn't grow tax free. And it's not a tax-free necessarily withdrawal, but you do have to pay taxes on it as you go. However, it's only tax on money that you make. So if you invest in something and it doesn't work out and you lose money, you don't have to pay tax on the money that you've lost. That shouldn't be the goal, but it is a consolation for losing money. So with any of these accounts, but specifically with the taxable account, the goal is to invest regularly and the same amount if you can afford it. And regularly usually means on a monthly basis. If we go back to the credit card example, if you had $250 that you could put towards your credit card debt, and now you have no credit card debt, you have $250 that you could put towards an investment account, whether it's a taxable account or a retirement account. What do we invest it in? Well, that's really a different topic, and we could spend many, many hours, days, months, even years on what is a worthwhile investment. But the easiest do it yourself thing is to invest in what's called a target dated fund. Um, any of the big, uh, what are called custodians, investment firms like Schwab or Fidelity, will have a target dated fund. It is a well diversified fund that is designed to make it so that the cash is available to you at a certain date in the future. 2025, 2030, they go in usually 5-year increments, 2035, 2040, etc. And the ones that are most distant into the future are more aggressively invested. That usually means in stocks. So they're going to be more volatile, but over time they're going to grow more. And the thing is that as that target dated fund gets closer and closer to the target date, it starts adjusting automatically from being more heavily in stocks, which are usually riskier and more volatile, to less invested in stocks. So a target 2025 fund, for example, is going to be only a very small percentage invested in stocks, because here we are in 2025, and a big portion invested in fixed income like bonds, which are not as risky. Whereas a 2065 or 2075 fund might be invested 85 or 90% in stocks and only 10% or 15% in bonds. So a lot riskier, a lot more volatile, but because you have so much more time, you can afford that volatility, is the thinking on it. And again, because I'm talking about the discipline of investing towards your retirement, the best way to do this is what's called dollar cost averaging, meaning every month I'm going to put the same amount into the same fund. So if the month that I'm putting it at my money in, the fund is high, I'm necessarily buying less of it because I'm putting in, say, $250. A month where the fund has dropped, I'm necessarily buying more of it because I'm putting in the same amount, say $250. So over time, my average cost is lower. This is called dollar cost averaging. And if I do this every month, repeat, 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 over time, it's going to grow to something. And if you've done it right, you can retire. Um, that's it in a short and broad way, which is what I said I wanted to cover. I imagine that people have specific questions, and I'd like to get to those.
There we go. It took me a few clicks to get myself unmuted. So I have a couple of folks who went ahead and put their questions in chat. So let's start with those. Sarah Williams put a fabulous question here. Sarah, why don't you go ahead and put yourself on camera and take yourself off mute so that you can have a discussion with David, because I'm sure there's other people who are going to learn a lot from that conversation between the two of you. And if for some reason you're not able to get yourself off mute, let me know and I'll read the question. Okay, so I'm not seeing Sarah yet. So what she put in here as her question was she's got a UTMA account for kiddo, but she wants advice on it. So anything you're able to share, since we're not able to get her to
Sure.
come share, that would be
Uh,
great.
UTMA or an UTMA account is a custodial account. It's actually named Uniform Transfer to Minors Act account, meaning that this is sort of a savings account for a minor, and you can make it so that it doesn't belong to the child until age 18, or in California, age 21, at which point all of the funds in that account belong to that minor. But uh, between now and then, when the child reaches age of majority or 21, you can use those funds for the child's benefit, as long as it's not for basic necessities like rent or food or clothing. You can do it for violin lessons or summer camp or tuition, books, etc. And in terms of how to invest it best, if your goal is to, say, have these be college funds, then I would just buy a target dated fund that lines up with the freshman year, expected freshman year for your kiddo.
Cool. Thanks. Cyril's got a question in here, and Larry does, but let's see. Shahab, are you able to, Shay, are you able to get yourself off mute and share your question?
Yes, when you talked about the Roth IRA limit of $7,000, is that if it's a married couple, do they get to invest 14,000 or is it limited to 7,000 per couple?
No, it's per individual. So
Okay.
if it's a, thanks for the clarifying question. If it's a married couple that earn less collectively than $236,000, each can contribute 7,000 to their own individual retirement account, or 8,000 if they're 50 and older.
Thank you.
Well, Shay, are you able to bring yourself off mute? Because you've got a great question that's also about the Roth IRA. Let's see. If
Hi,
not,
David. Hi, Linda.
there we go. Great.
Hi.
How's it going? Thank you so much for the presentation. It was fantastic. My question is with regards to the Roth IRA. I wanted to know if I make less than $7,000 a year in earned income, would I be able to contribute to my Roth IRA from my savings?
No, you can contribute the maximum of 7,000 or 100%. I'm sorry, the either $7,000 or your earnings if they're less than $7,000, whatever is less. So if you made $4,000, you can contribute $4,000 to your Roth IRA. If you made $100,000, you could contribute 7,000, but you cannot contribute more than what you've earned. Good question.
Thank you.
So, David, I made note of a couple of questions. So, one is once upon a time, the advice was if you've got credit card debt, quick, shove it onto a home equity loan. But with everything that's gone on in the home loan world, I don't know what the suggestions are nowadays or if one can.
That's a great question, and this is sort of an individual circumstance kind of a thing. So, you know, just know that what I'm about to say isn't necessarily the case for everybody. So it's really a dependent on your circumstances. But the way that we think about eliminating credit card debt and any interest debt, interest bearing debt, is that we want to attack the one with the highest rate. And so we want to attack it either by transferring it to something that has a lower rate or paying it off. And if we don't have all of the money to pay it off right away, then we want to transfer it to something that has a lower rate. Historically, home equity lines of credit, which is a loan that you can get against the value of your house, and if you have good credit and you can demonstrate income, that they are typically lower in interest than the credit card interest rate, the typical credit card interest rate. Historically, you also were able to write off, deduct taxably the interest attributable to your home equity loan. However, it's not necessarily the case anymore that you would be able to deduct that interest. There's a limitation called the SALT limitation, and which was put in 2017, that says you can only deduct up to $10,000 combined of property tax, mortgage interest in some cases, and other expenses. So it might not be that it becomes a deductible expense, but it's almost always going to be less than what's on the credit card.
I was just going to say that's a radical change. And folks who back in the 80s and 90s used to be able to shove tens of thousands of dollars of credit card debt onto an equity line of credit. That. ELOC, that's gone. Those days are gone.
It depends. It depends. If you can qualify for one, and the interest rate is less than what you would be paying on the credit card, it's a good idea. But it's not one that you want to sort of like think that you've finished. If you've just transferred your credit card onto your home equity line of credit, you've not finished with your debt. You still need to attack it and pay it down.
Yeah, yeah. Let's see, Shay, do you want to come back and ask your question again? Your next question.
I'm back. I've got a follow-up question with regards to Roth IRA. I wanted to know, for latecomers like a recent immigrant like myself, is there a way to catch up on Roth IRA contributions? I've heard about mega backdoor Roth IRA, but it's very confusing. The more I read about it, the more confused I get.
Yeah. So this is the way the backdoor Roth works. You'll remember I said that if you make a certain amount of money, $150,000 if you're single, or $236,000 if you're married, if you make more than that, you're not qualified to contribute directly to a Roth IRA. You make too much money, you can't do it. But you can do what's called a backdoor Roth IRA, meaning you contribute to a regular IRA, which works a little bit differently than the Roth, and then you convert it into the Roth IRA. So the net effect is that you end up getting into the Roth IRA, but you don't do it directly into it. And it's silly, and you think, well, if I can end up in the Roth IRA anyway, why do I need to go through the leapfrog effect? And the answer is IRS. And it was because it used to be that you weren't allowed to convert a regular IRA into a Roth IRA if you made too much money. But then during the Obama presidency, they got rid of that limitation, and they never put it back on. So even if you can't directly contribute to the Roth IRA, you can contribute to a regular IRA and convert it into a Roth that way. But I imagine that your circumstances are really specific, and so we probably should talk about that separately if that is the case.
But it's an interesting concept. I'm glad he raised the question, because in concept, you would put it into a regular retirement account that you're putting it in tax-free, and then a portion of it you'd move into the Roth and pay the taxes upon entry into the Roth. But then you're planning to grow it over coming years, and therefore you've already paid the taxes on the way in, and you're not going to pay the taxes on the Roth portion of your retirement savings and earnings. So you just have to be willing to do the domino effect.
Yeah,
So,
and pay the tax. So another one way to that when they lifted the income limitation in the during the Obama administration, on it was at that time it was $100,000. So if you made $100,000 or more, you were not eligible to convert your regular IRA into a Roth, even if you're willing to pay the tax. Then they lifted it. They said, okay, you can make $1 million a year and still convert. So many people had hundreds of thousands of dollars that they had accumulated in a regular IRA. And the regular IRA works like a 401k that where you pay tax when you take the money out. So they considered converting it to the Roth so they wouldn't have to pay tax on the way out. But if you convert that $100,000 regular IRA, then you got to pay the tax as though you earned that 100,000 that year. So, which means you have to have probably 35 or $39,000 somewhere else so that you could pay the tax and then have your $100,000 now in a Roth IRA. And that's a big chunk to swallow. And you have to consider, what about the lost earnings on that 39,000 that I've just given up? So it's a complicated uh, calculation to determine whether it's the right thing to do or not.
yeah, this is when
But
we turn to you and say, please create the spreadsheet so I can understand the implications of
yeah,
that decision. So,
but Shay, in short, the backdoor Roth exists, but it's rather complex and it requires a good deal of calculation to determine whether it's worth doing.
well, while we wait to see if anybody else has any questions they'd like to pose, there's another topic I just want to add in, which is this whole notion of where to come up with the money to use to pay down your debt. And I was having dinner with a colleague of mine who makes a very nice income. His income fluctuates a lot. So, in thinking about paying down debt, in his mind, there was no monthly number that he was just going to use to pay down debt. And then he found out about one of these apps, which I regret that I can't think of the name of right now, that basically you put in all of your accounts and it goes combing through them and it looks for all your subscriptions. And it highlights the fact that every single month you've been paying for the such and such subscription, and it asks you, do you want to continue or not? And because it's putting it up there in your face, you can look at that and go, I've been paying $35 a month for that. Well, he did that. And the first pass that he did, he came up with $300 a month. And he said, what would I rather be using that 300 for rather than this subscription, that subscription, this newsletter, and that, channel with old movies that I watch every 4 or 5 months? He literally pulled together the money he had been spending on subscriptions. He had complete amnesia about those subscriptions. And that became a monthly chunk of money that instead he was deliberately directing to paying down his debt. So, yeah,
Yeah,
you can
I
always,
know there are a number of apps that do that. I think that if you just do a search for find my recurring payments or whatever, that an app will pop up to do it. Read the fine print though to make sure that the app doesn't also charge you $35 a month to have it.
or you get it for 1 month. Get rid of all those subscriptions, and then get rid of that subscription too.
Yes.
Okay, you got another question? Come on back on camera and ask another question.
Hi, I'm back. Sorry, I don't mean to dominate the chat. I wish that others, I mean, there are quite a lot of people here. I hope that they would chime in. My question is with regards to e-locks or SB locks, which Linda mentioned earlier. I was wondering, is it true they say the loan, since it's a loan, it's tax-free, and better yet, it can be the interest payment can be a write-off, and yeah, if you could shed some light on that, I would appreciate it.
Yes. So loans are always tax free because it's not income to you. You're just borrowing the money. You pay it back, and so uh, you don't have to pay tax on money that you've not earned. It's tax that it's a loan, so it's a temporary gift. So you don't ever have to pay income tax on the loaned funds. The interest, however, whether it is a tax deduction, the interest that you pay or not, often depends on the nature of the loan, what you're using the funds for, and other limitations. So until 2017, it used to be pretty liberal. For example, you could borrow money against your home and you would get a tax deduction on the interest paid back towards that with almost without limitation. And then you could use those funds to invest in a business, for example, and you couldn't take double deductions, but you could get the interest deducted from because it was attached to a home. Now they're very specific about what you're using the funds for. One of the things that, just backing up to the old home equity lines, you could get the deduction for the interest that you paid on the home equity line unless you used the funds to invest in an a tax-free investment like a municipal bond. So you couldn't get a deduction for using on the interest for using the funds on something that came to you tax-free. But other than that, you could write off the interest. Now it has to have a direct business relationship in order to write the interest off if it exceeds certain other limitations related to a home, for example. But on a small business line of credit, you're supposedly not going to be getting the loan unless you're using it for a business function. So that interest would be tax deductible, provided that the business has enough money to exceed the interest that you're paying, because you can't deduct money for on interest if you're not earning that much that would otherwise be taxable. Does that answer? Oh, and Shay, I want to mention one other thing that you had said. You asked about, the whole reason about doing the backdoor Roth, because about catching up. You don't have to invest in a Roth to catch up. If you have additional money, like from savings, you can invest in a taxable account. There aren't the tax advantages that come with a Roth or a 401k or a traditional IRA, but you can still invest the money. So if you have savings to invest, don't think that you're locked because you can only do $7,000 a year or up to your earnings. Invest your savings, provided you have the emergency fund.
Yeah, sorry, I was on mute. Yes, that did answer my question. It was very helpful. Thank you, David.
Great. So Sarah's got a question and Deborah has a question. Sarah, are you able to bring yourself off mute? And if not, I'm happy to read it. So Sarah's question is also, if you own a business as sole proprietor and you do your own Roth IRA, can you pay yourself into your own IRA through the business separately as you yourself are a self-paid employee?
Okay. If I understand the question correctly, the business cannot directly pay into your Roth IRA for you. The Roth IRA has to come from your own checking account that is presumably paid to you by your business. So the business can't invest in the Roth IRA for you because that expense presumably would be deductible to the business, and you'd be getting away with not paying tax on money that should be taxable. So the business pays you, and then you invest in the Roth IRA. You can do it that way. The business, however, can pay into a 401k, and there are such things as what's called individual 401ks. So those are for sole proprietors. So the business can pay into a 401k on your behalf as the employee, and that will then grow tax-free. business gets a deduction for doing that. It's an expense of the business, so they get deducted. It goes into the 401k where it's invested intelligently into a target dated fund. It grows tax free, and then you pay tax on the way out. But it gets all of those years of tax free growth. So you can do it that way. And sole proprietors, as I said at the outset of the presentation, have a very wide spectrum of retirement plans that are available to them that are not available to employees who get a W-2.
Cool. Deborah, would you like to bring yourself off mute and have a conversation with David?
Hi, let me turn my camera on. Oh, start my video.
There we go.
Hi.
Hello
Um,
from Hawaii.
I'm actually in Burbank, California.
Oh, here's my next guest.
I'm a teacher and I will have a teacher pension through CalSTRS, the California State Retirement with Teacher Retirement System. But I've also have a 403B. Um, I have stopped contributing to the 403B because I need to go back to um step no, not step one. I need to go back to step job number two, which is to have the 5 month or 3 month expenses covered. So I am building that. But once I'm done building that reserve, I want to continue putting money into the 403B, but do you recommend, is there like an advantage over should I do a Roth IRA or a 403B or what's better?
Okay. Um, Firstly, thanks so much for being a teacher. I used to be a teacher, so I really appreciate the work that you do, and I'm grateful to you. I'm sure your students are too.
Oh, thank
Keep up
you.
the good work.
Thank you.
Now, you'll build up your reserve, and as a teacher, teachers typically are in high demand and don't typically go longer than 3 months without having a job. So you don't need an emergency reserve that exceeds 3 months of expenses. That one is fine if you do 3 months. Now, contributing to the 403b, contributing to the Roth, if you have to make the decision. The first thing is, does the school or does the district match your contributions to the 403b? If the answer is, sorry?
Sorry, go ahead. Go ahead.
I was going to say, well, if you know the answer, then go ahead and tell me.
They don't.
Oh, they don't. Okay. So then what you're going to do is, provided you make less than the limitation, 150 or 236 if you're married, you are going to contribute the full amount that you can afford up to the $7,000 or $8,000 if you're over 50 to the Roth. If you have money extra left over, throw that into the 403b.
Oh, okay.
So Roth would be first because you get the tax-free growth and the tax-free withdrawals. And then the 403b would be second because you get the tax-free growth, but you don't get the tax-free withdrawals.
Okay. Thank you. So I'll start doing that. And I know that where I have my 403B account, they also offer a Roth. So I could keep it all in the same place because I don't want to have something like over here and then something over there. I just want to be able to log into one place and see both. Do you advise that?
Yeah, that's a good idea. It's a little bit more organized. In some cases, they might charge administrative fees on the Roth. And if that's the case, then I would go with Schwab or Fidelity or E-Trade, which does not charge a fee for the Roth, but they probably won't charge an administrative fee. And then just target date fund.
Oh, okay. So the target date funds are You said that? Let me see. Hold on. I was taking notes while you were talking. So, um,
Sometimes they call it life cycle funds, but they're the ones that have the dates on them. And so you would just choose the one that has the date closest to your anticipated date of retirement.
okay.
David, what's important about that is if you've picked a target date fund, do you need to monitor it monthly? Do you need to make choices about what your funds are invested in, or you just put the money into the target date fund and hands off?
That's it. Thanks, Linda. Yeah. That's the big benefit of the target date fund. It's a set it and forget it kind of a thing. It will self allocate from riskier to more conservative as time goes on. Because, like I said before, the idea is when you get to that date, it expects that you're going to need the money. So it doesn't want to be as risk taking as you're getting closer and closer to that date. It wants to take the risk off, so it's going to self-adjust from riskier investments that have the potential for higher return to less risky investments that don't have this higher return, but you're not going to lose money. So if your anticipated date of retirement is 2050, buy the target dated fund that says 2050 on it, and it will self-adjust. Set it and forget it.
Okay, thank you.
Shay, come on back on camera again.
Hi, it's me.
Hi.
I had never heard of target date funds before, and I'm curious to know, are they like products similar to ETFs with like a ticker symbol that you can purchase through your brokerage account?
Absolutely. Yes. And so target date fund is the general term for it. Each company has its own nifty marketing term for it. Some call them life cycle funds, some call them retirement funds, uh, some call them future date funds. But the way that you can recognize them is that they have a date attached to them. So if you have an account, say at Schwab, and there's a search bar and you say, I want to buy the 2065 target date fund. If you put 2065 on there, it'll say, here are the ETFs that have the 2065 option.
Oh, Roger that. Thank you so much.
Sure.
Maria, you've got a question. Would you like to come on camera and join in the conversation? There we go. And we need you to unmute. There we go. Perfect.
Hello, Samantha
Hello.
Laundromat. Um, so I was wondering if, since the Roth has a 7K max contribution, if you're under that 150, is it possible to invest like 7K into that and also invest into a 401K?
Yes. Yes. A 401k and a Roth IRA don't cancel each other out. That's a great question. But you couldn't have, say, a Roth IRA at this company and a Roth IRA at this company and do 7,000 and 7,000. It has to be combined. However many of them you have, the total is 7,000. Same with a 401k. I've got a 401k here and I've got a 401k here. My limitation is if I'm under 50, 20,500 between all of them. So, but great question. But you can have the max 401k and the max Roth IRA, and they don't cancel each other out.
Okay, got it. So as long as you don't have more than 7,000 in any Roth and no more than the 2,500 in any 401k, you can have them added up together though.
20,500 in the 401k, not
20,500.
20,500, and 7,000 in the Roth IRA, but that's per year. So it's not the
Yeah, per
value,
year.
it's per year.
Okay, got it. Thank you.
Sure.
Thank you for posing that question. I love it. So, David, we're just going to wrap things up right now. If you have anything that has occurred to you that you want to add before we wrap it up.
There is, and it's for Deborah, which is that because she's a teacher, um, I mean, it's wonderful that you don't have debt, and that's just great. But if you have any needs, JFLA specifically has a loan fund that's for teachers. It's at 0% interest, like all of the loans, no interest and no fees. So it might be something you consider investigating. JFLA.org Teachers Loan Fund.
Fantastic. Thank you so much for bringing that into our conversation today. So, folks, as you know, this has been recorded, and the recording is going to be sent out in an email. David, do you want people to be able to reach you? If so, we can include that contact information in the email when it goes out.
Sure. I'm happy to talk with anybody if they have a question. Please email, I think Zoe or anybody at JFLA, and they'll make sure to get your message over to me, and we can talk then. And let me also just say one other thing. It's not my quote. It's from Charlie Munger, who was recently passed away, and he was the partner of Warren Buffett, the world's most successful investor of all time. And Charlie Munger said, always be saving something. Don't look at it. Eventually, it'll be worth a lot of money. And I agree.
Yeah. Thank you. Thank you so much for being here, David, and everything that you shared. And it's so important. You know, people may have thought about this 5 years ago, but stuff changes in tax law and everything else. So it's so worth getting the full discussion up again. So thank you for everything. I learned things, and I'm sure so did everybody else who's here today thinking about retirement planning and so on. So folks, we hope that you will join us for our next financial literacy event in June, which will be focused on debt management, and more details will be shared shortly. So keep an eye out for that in your email. The recording will go out as a link in a follow-up email as well. Feel free to forward it to anyone you know who might find this helpful or might be interested in joining the future literacy program events and so on. And in the meantime, if you're interested in learning more about us and helping us provide more zero interest, zero free loans to the community, you can scan that QR code that just showed up on your screen, or you can visit jfla.org/ways to give. Ways to give with dashes in between the three words. So thank you for joining us today, and be well, everyone, and take care. Bye-bye.